SpaceX is going public this week. OpenAI just filed confidential paperwork with the SEC. Anthropic announced it's targeting an IPO as soon as October. These are three of the most hyped companies on the planet, and for the first time ever, regular people are going to have a chance to buy a piece of them. And the internet is losing its mind. But before you log into your brokerage account and go all in on SpaceX, there's something you need to understand. Because the data on IPOs tells a very different story than the hype does. So today, we're going to break down exactly what an IPO is, look at what actually happened to investors who bought into the biggest IPOs of the last decade, and then come back to why SpaceX, OpenAI, and Anthropic might not be the layups everyone thinks they are. Welcome back to Compounding with Callie, where we compound some miles and our money. Let's get straight into it. An IPO stands for Initial Public Offering. It's the moment a private company sells shares to the public for the first time. Here's a simple way to think about it. Imagine your friend has been running a pizza shop for 10 years. It's profitable, it's growing, but to expand to new cities, they need a lot more cash than the bank loan can cover. So they decide to split the company into a million tiny pieces, called shares, and sell those shares to anyone who wants to buy one. In exchange for that cash, you own a small percentage of the business. That's exactly what companies like Uber, Airbnb, and soon SpaceX are doing, just on a much, much larger scale. Before a company goes public, it's privately owned, usually by the founders, early employees, and venture capital firms who took a chance on it early. The IPO is their exit ramp. They get to cash out, the company raises money to grow, and regular investors finally get a seat at the table. The process works like this. The company hires an investment bank, think Goldman Sachs or Morgan Stanley, to figure out how much the company is worth and set an initial share price. That bank then sells those shares to big institutional investors first. By the time it hits the public market, you can buy it through Robinhood or Fidelity account, but those institutional investors already got it at a better price than you did. And that's the first thing to keep in mind. You are not first in line, not even close. Now here's where it gets really interesting, because when you hear IPO, you probably picture a stock that explodes on day one and makes early investors rich. And sometimes that happens. But let's look at what the data actually shows for the biggest, most hyped IPOs of the last 10 years. The ones you actually heard of. Let's start with the winners to be fair. Snowflake went public in September 2020 at $120 a share. It was the largest software IPO in history. The stock more than doubled on its first day of trading and was up roughly 170% from the IPO price by the end of year one. That's a real win. Airbnb priced at $68 in December 2020 and opened its first day of trading at $146, more than double. 1 year in, and it's still sitting well above the IPO price. DoorDash priced at $102 and jumped 85% in 1 day. Also a strong first year. Those three look great, but here's the problem. 2020 was one of the most unusual years in stock market history. Interest rates were near zero. The Fed was pumping money into the economy, and investors were throwing cash at anything with a growth story. Those IPOs launched into a perfect tailwind. Now let's look at the rest. Uber went public in May 2019 at $45 a share. On its first day of trading, it actually fell. A year later, it was still below the IPO price, down about 30%. Uber eventually recovered years later, but the people who bought at the IPO had to wait a long time to even break even. Lyft IPO'd at $72 in March 2019, just weeks before Uber. By the end of year one, it was down over 60% from the offering price. It never recovered. Today, Lyft still trades well below where it opened. Coinbase went public in April 2021 at a reference price of $250. It opened at $381 on day one, which felt incredible. By April 2022, exactly 1 year later, the stock had collapsed to around $65. That's a loss of roughly 70% from where it opened in just 12 months. Robinhood IPO'd in July 2021 at $38 a share. By year one, it was down about 75%. Rivian, the electric truck company, IPO'd in November 2021 at $78. Briefly hit $150 billion valuation, which made it more than Ford. But 1 year later, it was down roughly 75%. And lastly, WeWork, which we never completed a traditional IPO because its first attempt imploded, eventually went public through a SPAC deal in 2021 and filed for bankruptcy in 2023. So let's add this all up. If you had put all equal money into these 8 major highly publicized IPOs, your average 1 year return would have been roughly negative 20%. and that's including the 3 strong performers. And take out those 2020 outliers, and the average dropped to around negative 50%. For context, the S&P 500, a simple index fund you can buy in 30 seconds, returned around 28% in 2019, 18% in 2020, and 28% in 2021. While IPO buyers were losing money, the boring index fund investors were building real wealth. So why does this keep happening? There are a few reasons. First, by the time a company goes public, it's already been valued by the smartest money managers in the world, the venture capitalists and private equity firms who invested in it years earlier. The IPO price is set after they've already made their money. You're not getting in early. You're getting in at the end of their trade. Second, the hype machine is working against you. The media coverage, the social media buzz, the CNBC countdown clocks, all of it creates artificial demand that inflates the price on day one. That's great if you somehow got shares at the IPO price, which most retail investors don't. If you buy on the open market after it starts trading, you're often paying a premium on top of a premium. And third, newly public companies are often unprofitable. They're growing fast, but burning cash. The moment the market mood shifts, like it did in 2020 when interest rates started rising, growth stocks and newly public companies get hit the hardest. Here's a practical takeaway for beginner investors. Patience is your edge. The single best thing you can do with a company you're excited about is wait. Wait 6 months. Wait a year. Let the IPO hype fade. Let the lockup period expire when insiders are allowed to sell their shares, and watch what the stock does when nobody's hyping it up anymore. In most cases, the price comes down, and that's when you actually want to buy. The investors who waited to buy Uber in 2020 instead of at the IPO made real money. The investors who waited on DoorDash bought at a much better price when it pulled back. Patience almost always wins. Which brings us back to SpaceX, OpenAI, and Anthropic. SpaceX is pricing this week at a valuation of $1.75 trillion. That's nearly 3 times the previous record of the largest IPO in history. OpenAI's private valuation is sitting around $852 billion. Anthropic is targeting $900 billion valuation for its listing later this year. Together, these 3 IPOs could demand more than $200 billion from public markets. In a year where the entire US IPO market raised only $45 billion in all of 2025. These are genuinely revolutionary companies. SpaceX is rewriting aerospace. OpenAI put AI in the hands of billions of people. Anthropic is building some of the most advanced AI systems on the planet. But revolutionary companies and great investments are not the same thing. Facebook was revolutionary, and it fell 40% in the first 3 months after IPO. Uber was revolutionary, and it took years just to get back to its offering price. The hype around these IPOs is going to be like anything else we've ever seen. And that hype is exactly why beginner investors should be cautious. You're not getting in before the excitement. You're getting in because of it. If you're interested in any of these companies, watch first. Research them, understand their business models, but let the dust settle before you deploy real money. The market will always give you another entry point. The worst trade you can make is buying at the peak excitement and watching it crater for the next 12 months. Thanks for tuning in. Same pace next time. Keep compounding.